Welcome, and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Fort Worth, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, a PDF of today's presentation is available for download now, should you wish to follow along or reference it afterward. With that, let's get started. I'd like to introduce our speaker today, who is Matt McKinney, our Senior Director of Tax Accounting Methods and Credits. Matt has over 22 years of combined public accounting experience in the areas of tax compliance, accounting for income taxes, capital cost recovery analysis, and accounting periods and methods. While Matt has served many different clients for tax compliance and consulting, he has specific industry specializations working with public utilities, telecommunications, aerospace and defense, and manufacturing companies. With that, I will hand it over to Matt.
Thank you, Ann. Welcome, everyone. Today's topic is going to be update for depreciation and the impact of the One Big Beautiful Bill we passed here. So the first part of this can be, a little bit of a refresher. And if you've joined us before, we're going to talk about the fact that we are back with 100% bonus depreciation. And some of the acquisition versus place in service rules there. And then what is probably the larger topic I'll move into in the second half, and I'll also try to leave some time for questions, is qualified production property and the updates that we have received there and where we go from here. So as everyone I'm sure knows at this point, with the election of Donald Trump and then the One Big Beautiful Bill, for property acquired, and that word is highlighted for a reason, and placed in service after January 19th of 2025, bonus depreciation is 100% until it gets changed. So it is, as of now, permanent in the tax code, but we'll see, if that plays out over time. But for now, if it's acquired after that date and then placed in service, 100%. And then with this, before we had qualified improvement property, we've been whittling down non-residential real property. And so now with OBBBA, we introduced qualified production property, or QPP as we'll use the acronym. Again, for this property, if construction begins after 19th of January 2025 and before January 1, 2029, and then it's placed in service between July 4th, 2025, and then before January 1, 2031, you get 100% bonus depreciation on this property if it meets the certain qualifications that we'll talk about later. While we do have just a short window in comparison to bonus depreciation itself between all of the reinstatements, retroactive or not, has been around since essentially 2001. This, I'll be curious to see how long it's around, but as of now, there is just this short window for this type of property, for which we'll go into more detail on recent guidance later in the presentation. And here's our first polling question. I'll read it and then give you a little bit of time to answer, and then we'll keep going. Excuse me, I might need you to read that. I don't have a...
All right, I've got it. Are you interested in obtaining CPE for this session? A is yes, B is no. It is our first polling question, so you're in luck. Also, if you have any issues seeing the polling question, please make sure your brightness is up. And if you have any technical issues during the program today, please contact me directly using the chat or Q&A. I'm Ann Romano. And it looks like the majority says yes. The 3 who say no may be employees. I don't know. But I think you're ready to go forward.
Perfect. So the reason I highlighted that, and this comes up for us a lot, and from the start when 100% bonus depreciation came back, we would have prospective clients that did not understand or know, because the statute doesn't necessarily spell it out, is that it doesn't matter when you place the property in service. It actually also matters when you acquire it. And the only reason I still have this in this presentation is because we still have so many 2025 tax returns out there. But the further we get away from January of last year, the less important that this is. But it is important for our clients to realize that if you have a written binding contract for a property before that date of January last year, then that property is considered acquired if it meets certain other applicable rules. The main rule that we focus on is the second bullet about essentially there has to be a damages clause, or the purchaser has to be on the hook for at least 5% of the contract for this to be binding. And so a lot of the properties that we deal with are real estate. And so that you have your escrow and your the amount of money you pay with entering in the contract. And so a lot of times we look to that amount and where it falls within this 5% threshold. But the main reminder here is for for property that you purchase, if that contract has been out there a while, it's something you may have to look at. But again, starting now and here in the short future, this is going to be less and less of an issue. Polling question 2.
All right. Have your clients increased the amount of fixed asset purchases due to the impact of 100% bonus depreciation? A is yes, B is no. This is the second of 4 polling questions. Okay, it's fairly evenly divided at this point, with a yes winning by just a small margin.
That's interesting. So the acquisition rule. So this is for your constructed property, and this we deal with more, probably more so than the acquired property. And this is gonna follow us into QPP as well. So when you have self-constructed property, and what we deal with here at Source Advisors with cost segregation is when you are constructing, whether it be a manufacturing plant, residential real estate, non-residential real estate, that construction begins, or when you acquire that property is when significant work of a physical nature begins. And so, but there's also a safe harbor for this. Now you can use there is a rule that's a little more subjective, but in my entire career, everyone has always used the 10%. And so what we're looking for is, did you begin or did you incur 10% of your construction cost before January 20th or January 19th of 2025 or before? And your accounting method matters. If you're cash basis, is when you pay it. If you are accrual, it's when you incur it or when your property or services are provided. And so that you do have to get into that detail. And there is a little bit of a workaround for self-constructed property. But what we've also found is, interestingly enough, that we have clients that they prepaid for materials. They acquired, building shells, things like that, or materials in advance of the construction beginning because there's a price point differential. It was cheaper to do so. The problem with that is they believed that they were going to get 100% bonus depreciation on the items that we were able to move from 39 year or 27.5 into 5, 7, or 15. And that, that answer wasn't as straightforward as what they maybe thought it would have been. So again, just as a reminder, this is going to be less important as we move further and further away from that date of January 19, 2025. But for self-constructed property, it does require us to ask the question and figure out, when did we incur our cost? So now let's talk about a little bit of the workaround. And this has been, this came into regulations in TCJA, but I believe it was first in a revenue ruling back in 2011, I believe. But it came into the regulations via TCJA, but the fact that it came in probably 2 years after we had our first 100% bonus depreciation date under TCJA, it really didn't get the use that maybe it could have because the regulations were so far after the fact. But essentially what this is for self-constructed property, it allows you to take components that you self-construct or acquire for this property. And if you acquire them after that January 19th date, you can get 100% bonus depreciation on those items. And so it does help for, and where we see it is, in construction, whether it be manufacturing or, a building that we are going to do a cost segregation study, it does allow us to pick up a percentage of those costs, that if we just looked at the acquisition or construction rules, we would have lost out if we stopped there. But this component election allows for us to recover some of those at 100%. Your acquisition, your self-constructed rules are the same as what we just went over. So you still have a 10% safe harbor on the components that you self-construct. You still have to look at binding contract rules for components that are acquired. And, when we're talking about, cost segregation of a building, you end up with a mix of both of those. And, most of this I already talked about. At the bottom, I talk about special rules apply to residential rental, non-residential rental property. So to be eligible for the component election, you have to have property that components of property that itself are eligible. Well, on first thought, you would say, well, residential or non-residential real property, they're not eligible for bonus. Well, the regulations were very taxpayer favorable here, and the rule essentially is that the property is all of the short life, all of the 1245 property within the building. So that is the larger asset that you're looking at for the component election that allows for us to use that with real property construction, which is good. But if you look at the regulations, I think there's 4 examples. Most of them deal with locomotives, vessels, power plants. And yes, there is one example on a building where there have been components identified that are actually 1245 property. What is the difficult part, the regulations just completely skip over. And they start with, these are eligible, and we know when these costs were incurred, and they don't go through the hard part of the identification and then the identification of when those costs were incurred. So again, even with this, your accounting method is going to matter. If you're cash basis, it's when you pay for it. If you're accrual, it's when property and services are provided. And this does actually require an election statement. So just as we've gone from one busy season and we're working our way into the next, that if you do have clients that are making the component election for or you have clients where you're helping them with dividing out these components of a property that they've acquired where they believe they can capture 100% bonus depreciation. Remember this election, and I go through the rules here, and then it actually in these regulations were under K2, and we'll talk about that in a second. It does detail out what steps you have to provide, but it is an affirmative election. So unlike bonus depreciation in general, where you're deemed to be elected in unless you elect out, if you're going to use this, you do need to make sure there's an election statement in that tax return. And some of the issues I'll just talk about a little bit. When I talk about record keeping and documentation, the issue we see with our cost segregation studies is it becomes an accounting exercise to determine when these costs were incurred. So if you have a construction contract that straddles between you start in November 24 and it is finished in July of 2025, you're going to have to dive into those pay applications. You're going to have to determine, when each thing that you're going to, determine as 1245 property, whether it be wiring, electrical, cabinetry, items that are essentially machinery and equipment, anything that's going to go from what would be, say, a 39 or 27.5-year life into a shorter, say, 5-year life, you're going to have to capture all of those and determine when each component is acquired. And the hard part is which components are acquired versus which are self-constructed, because there's certain things that just the materials show up, like the wiring. But then if you're thinking about your HVAC system, you have the piping and venting and things of that nature, but then you actually have the air handlers that show up on site. So getting into the contracts and things like that matter, and it can get into the weeds pretty quickly. However, one thing that I think everyone also needs to understand is that this can become a very large exercise very quickly, but it's not all or nothing. If you make this component election, you don't have to take everything. You can pick and choose. And that is something that you have to throw into your substantiation, your election. But it is a way to say, hey, there's an 80-20 effect here where we know that our finished carpentry didn't even begin until after January 19th, or we know that our flooring did not go in. There are certain things that you can probably easily identify based on dates versus, well, if you're going to take part of the electrical, part of the HVAC, part of the plumbing, depending on the type of situation you're in. Well, some of those things start very early, and that's where this math exercise begins. It really drags this down into the weeds a bit. But I did want to point that out there, that it's not all or nothing. Polling question number 3.
All right. Do you believe the introduction of QPP will be significant to your clients? A is yes, B is no. This is our third of 4 polling questions. And again, we're somewhat evenly divided, with the majority saying yes. You do have a few questions. I don't know if you'd like to address those now or wait till the end.
I will wait till the end, but I am going to keep moving, and I'm going to pick up the pace a little bit. So, as I said, when the law was changed and OBBB came out, there was confusion around, well, you're telling me that I have to follow these acquisition rules, but I don't see it in the statute. I just see placed in service. Well, the easy answer, but not the easiest to give, is, well, we've seen this movie before. We have two sets of bonus depreciation regs, -1, -2, and they both say the same thing on acquisition rules. So finally, the IRS issued notice 2026-11, essentially giving us that answer that, hey, do what you've been doing before, and then also gave us guidance on how to elect 40% versus 100 if we were so interested in. And I will move on to qualified production property. So, and this slide is essentially what the statute tells us. It's for the new construction used as a integral part of qualifying activity, QPA, which we're going to talk about in a section separately here, is eligible for 100% bonus if construction begins between dates, and then your place in service is also between these applicable dates. It also includes property that was not used in QPA before. Now, your acquisition rules still apply there. You have to acquire the property after this date, and you've got to meet the definition of manufacturing, production, refining that I'll go over a little bit later. And then it's got to result in a substantial transformation of the product. The statute just plain and simply excluded office space, sales, parking, research, engineering, and other areas that are unrelated to the manufacturing, production, or refining. We are going to need regulations, but we will talk about here what we do have. So the IRS recently issued IRS Notice 2026-16. It is approximately 50 pages long, and it announces their intention to issue regulations, but also gives us guidance to use in the meantime. It tells us what QPP is, so how do you identify and measure out qualified production property. Then it gives us definitions on what is considered an integral part of QPA, or qualified production activity. There was a couple useful rules in this notice. One, if QPA is conducted in the space or portion of property, and if that is essentially 95% or more of the property's physical space, then by election, you can treat the entire property. It's essentially a de minimis rule that you can, and we actually had one the other day where it's 94.4. So just on approximate measurements, and I said, well, we probably should go ahead and get exact measurements, because just 95% safe harbor is going to be our easy button. Additionally, each building is a single unit of property, and subsequent improvements or additions are treated as a separate unit of property. I'm going to pause there, because when I read that portion, and again, I'm summarizing here, something jumped out at me that wasn't originally, didn't read as such in the statute, is that you don't have to construct a brand new building or acquire a residential property that you turn into a manufacturing space to get this benefit. You can also get this benefit if you expand or do an addition or improve an existing property. So that's an important distinction in this notice, that this is not, this widens the net of who may be able to take advantage of this new QPP statute. Multiple properties that operate as an integrated facility on the same contiguous land may also be treated as the same unit of property. So all these things matter in the big picture when you're trying to measure these out. And as we go through these rules a bit more, both of those terms are very helpful to taxpayers. I will say the one thing that's not explained in this notice, and the notice, when I say it's 50 pages, there are examples that go for 3 pages. And I can summarize one of them later and just kind of give you again, just when I talked about the component election, the example skips over what I would consider the hard part. One of the things they don't tell us here is how does the taxpayer go about backing up this integrated facility? They also don't give us rules about, well, what if you have natural borders like a railroad track or something of that nature, or a road? Does that make it not a contiguous space? So there's some things that I hope come out in these regulations that we're probably gonna have multiple iterations of. There's going to be temporary or proposed, and then we're gonna have some back and forth. But those kind of details are left out of this notice. Most importantly, probably in this notice, and for small businesses especially, the statute essentially said if you're the lessor, you can't look to the lessee to determine whether or not your space qualifies. However, as all of you know, many taxpayers, especially smaller businesses, the real property is in the LLC, and then the operating company is in another LLC. The notice gives us a break for that. So essentially, for pass-throughs, if there's common ownership, then you have a reprieve. You get to count that. So if you're that small business that has the real property in one LLC and another, and the operations in another, or an S corporation, et cetera, you're not going to be forbidden from using this deduction. The notice goes on. It does talk about ineligible property, but honestly, it was consistent with the statute. It named everything I named in the first slide we have on QPP, but then it did add to that property used to store finished goods. So your office space, et cetera. No, it doesn't talk about bathrooms. I'm just going to go in and assume that those are integral, but it did say not used for can't be used to store finished products. So that's out. Now it is in if it's on the front end. So if it's used for receiving of components or raw materials, that qualifies. But once you have transformed this product, or you've complete your substantial transformation, then, that portion, that time or that activity after that will not qualify. Again, it goes back to this notice goes back to for when you determine when construction begins or when you determine property is acquired. It goes back to the same bonus depreciation rules that we've already talked about. So I will say it does do a good job of defining QPP, and that allows for integrated facilities, et cetera. When we get into QPA here, the definitions are not necessarily the best. They're very generic, and it's one of those things it when you see it. But there were a couple of things that that they also didn't talk about with QPP. The actual production part of this, when you're measuring out, if where that you have a qualifying production activity, but when you're determining what qualifies and what doesn't, they also didn't talk about what if you have a wastewater facility that's not necessarily in the same it's not a in a contiguous space or not part of your integrated facility, but it's being piped in. Does that count? This notice is silent, and I believe that's going to probably be something that is looked at, when we get to the regulations. But anyway, when we start to get, outside of, QPP, it's pretty simple in the notice. It tells you can use essentially any reasonable method, cost X, square footage, et cetera, to determine your ineligible versus your eligible spaces. And that portion is pretty easy. It goes through when you have related parties and the lessee we talked about. That's pretty easy. The examples are helpful. they explain the portion of, when you already have an existing space and you expand it and your new unit of property and how that qualifies. Those portions are easier, but when it starts to get into the qualified production activity is where I see it's a little light. Again, it's only 50 pages, and there's a lot of that 50 pages that's examples and also just the procedural stuff that comes out with the notice. So the notice defines QPA as a trade or business involved in manufacturing, production, or refining of a qualified product. The activity must result in a substantial transformation, which it defines, of the property that compromises a qualified product. You also have to sell this product, or sell it, rent it, et cetera. It can't be something you're just manufacturing for use. It also includes activities that are essential to its completing. So even the activity, if it's not transformative, and that's, say, the receiving of raw materials, the prepping of raw materials, those are essential. And, an activity is considered essential if it does these three things. It's got to be within the same property or integrated facility. Again, the regulations don't say what if you're doing it, across the way and you have to drive it over. It doesn't seem like that would be integrated, but that could be something that they need to address in the regulations. It doesn't incur in something that is listed as ineligible, like an office or design facility. Without the activity, the substantial transfer could either not occur or result in a product of a different quality or quantity. And so again, receiving works, but and then oversight. If it's and I have this in the bottom, vendor selection, et cetera, that works as long as it's not in a tainted section like an office. So if it's on site, you have vendor management, someone working, or product quality management, that someone's working in that QPP space, that someone is working in the eligible manufacturing facility, that works. But if they're in an ineligible part of the facility, that will not be deemed essential. So this is when we get into the definitions, and I will say I summarize these, but I hate to say I'm not sure that the ones in the notice are really that much better. So substantial transformation is the manufacturing, production, or refining of inputs into final, complete, and distinct item of product that is fundamentally different from the original inputs. And honestly, the notice continues to use the same examples that were essentially derived in the statute, where it pointed to other regulations. And it's the wooden screw, or it's the taking the metal rod and making it a screw. It's things that are very clear cut. But what they don't tell you is and it says that mere repackaging or packaging does not count. Well, there's going to be things that we all know. It when you see it is going to be clearly manufacturing, production, or refining. But there's also going to be things that ride a line that we just don't know. And that's where I'm hoping these regulations get a little bit better than this notice, because the definitions they provided us. I think the hard part of this is not going to be measuring the space. It's going to be, do you qualify? If you're riding that line of, someone asked me about a recycling plant. Well, initially I thought, well, there's no way, but there is, in this instance, there was more than just repackaging. There was, there's sorting, receiving, there was, there's, cleaning, and then there was, some extra element. I said, well, on the face of it with the statute, I don't think so. Even with the notice, I don't think so. But there is more than just taking the aluminum cans, send them down the conveyor, and box them up. And there were additional steps with this facility. But again, there wasn't a final product that I thought was substantially transformed. So I think there are going to be, gray areas that and maybe never will be defined in regulations. Manufacturing, they defined as materially change the form or function of tangible personal property to create a new item held for sale, rent, or lease. Production is limited to either agricultural or chemical production. So pumping oil out of the ground is not going to count. Refining, they talk about to purify a substance into useful or higher value product. And again, these are I have simplified these, and I will pull an example I have the notice here to show they do go in a little bit more detail, but I'm not sure if it's really that helpful of a detail. Chemical production, process formulate a product from raw materials, and a qualified product, tangible personal property, except for food and beverages prepared in the same building as a retail establishment where the food is sold. And there's actually been a comment already submitted on this one item. And so if you think about, depending on the area of the country you're in, but in my area, you have certain donut shops that not only produce the property there for sale on site, but they also produce the property that is then sold to grocery stores to be a reseller. And if they were in a corporate kitchen somewhere and did not have the retail establishment in the same portion, it would qualify. So I think there are going to be there may be some aspects to that maybe get looked at in the regulations. I know there has been a comment submitted by a certified public accountant, I think state association, but it'll be interesting to see if that is changed or if there's an update. And I hadn't really thought about it except for and I think they actually used the donut shop as one of their examples of how this might need to change. But yes, the examples do go into more detail. And I'll show you here. My example for manufacturing is one sentence, but essentially the actual notice says the term manufacturing means to materially change the form or function of tangible personal property, including parts and components, to create a new item of tangible personal property that is held for rent, lease, or sale for customers in an ordinary course of a trade or business, which is what I said. Additionally, they go on to say the form and function of the raw material is elements, parts, components, or other tangible personal property used as inputs is considered to be materially changed if, at the completion of the process giving rise to the new item of tangible personal property, the materials, elements, parts, components, or other inputs have been transformed such that they are distinguishable from and cannot readily be returned to their original state. Again, like I said, you're going to know it when you see it in certain instances, and that's going to be the easy ones. But if you think about someone taking, leather goods and, or leather and then making certain leather goods, that one gets a little harder in my mind. So that readily, though, none of those things are defined. And honestly, the examples don't, the examples in the notice are very clear. They are, there's one, and it's probably 3 pages long, that talks about, essentially making tomato sauce or salsa or something. And they go through each of the steps and receiving, et cetera, the quality control, everything qualifies. But when I'm reading this example, I'm thinking, well, this is kind of obvious, but what we really need are examples that show that dividing line. Unfortunately, I don't know if we're going to get that in regulations, but I hope we get more detail for those situations that they're clearly more than repackaging, but maybe we're not creating the next new chemical or et cetera that is essentially, we're not turning oil into gasoline or something of that nature that is very obvious. But I think we're going to need help with those things that are, where we're going to have to take a position on. One other thing I did want to make quick mention, and goes back to qualified production property, and then we'll get into this last polling question, is just because you're a contract manufacturer, this notice confirms that you're not out just because you're not the ultimate seller of this. You can still qualify even though you're in contract manufacturing. So Ann, I'll let you take it from there. And can you pull up polling question number 4? I did not see it. Actually, now I can at least read you the poll, and I'll see if I can get it started. Are you interested in being provided a summary of QPP regulations when they are introduced? And did that one already go?
It did go. I'm sorry, I was off microphone.
No worries. Perfect.
Okay. Yeah. So we are, 97 say yes, B say no. How are we going to, we will be emailing this out, I assume, to all who are interested?
Yes. If we do, when these regulations out, typically I think if we do an article, I think it certainly gets posted on our website, but I do believe that there are, or at least notifications linked, et cetera, that would be emailed out. And it is something that we would typically produce and put as part of our article. And it may actually show up on LinkedIn, et cetera.
Great. So we have all of our responses and we can move on.
Okay. So like I said, the notice, I think it does a good job of defining how you figure out your space. And it's pretty open, I would say, on how you can define your space and measure. How do you determine what's how do you measure between qualifying and non-qualifying spaces? I think that's going to be the easier part. I think there are certain things that it may not address, but I think that's going to be the easier part. I think qualified production activities, I think for when you're a heavy manufacturer, you're doing something that is clear as day, that you're like I said, you're refining gasoline or you're making fertilizer from a variety of chemicals, that I think that's going to be easy. I think where the notice falls short and where we're going to need some help is further defining what QPA is. This notice, though, it does give us something to go on, and that is more than we have from just the statute. And it does help us with the procedural elements of this. So first of all, there's a safe harbor for 2025 property and service. You can use your business activity code. The notice also talks about the specific rules for how you make the election. So again, this election is affirmative, and I will go through just some of the type of details, and it's detailed. And so unlike bonus depreciation, just remember, if you're going to use QPP, you have to affirmatively elect in. And I'm going to talk about why that matters, why you might still need a cost segregation study here in a second, because there's another portion of this that is punitive. But from an election standpoint, it talks about the notice tells you when and how you need to make the election. And it gives you the necessary items for your statement in this notice. And you have to have a statement that's pursuant to Section 7 of Notice 2616. And it has to have your taxpayer name, identification number, and for each property placed in service. So there's some work involved in this. You have to put the street address, the total unadjusted basis, if the eligible property is less than the entire property, the dollar amount, the dollar amount of your basis of eligible property that is designated as QPP. If you're applying that de minimis rule, remember the 95% that we talked about real early on, you have to note that. If you're using the automatic 1 year extension for place in service date, which is really, I think, only a 2025 item, and that's detailed in the notice. And so there's a variety of things, and then essentially it tells you that for you to revoke this, and that's very important, there needs to be some extraordinary circumstances. And so we're going to get into a little bit here, why, I get asked all the time, like, well, if I know that I have a building that is all manufacturing, why do I ever care about doing a cost seg? And, you don't have to, if you never have to worry about, what we're going to talk about on this slide, the recapture provisions in this notice, and as per the statute, can be quite punitive. So essentially, anytime in 10 years, if you change, if this space, if a portion, or if certainly if the entire property ceases to satisfy the integral part requirement, you're no longer using it for qualified production activity, and you're using it for something else, you have a recapture event. And that's why we would say, well, if you're uncertain that in this 10 years that you may change this space, et cetera, then figuring out if you have 5, 7, 15 or QIP, if you have an expansion of an existing facility or you acquired a facility, it may be important to figure out the fact that you have QIP. Nothing else. Remember, you're going to have some state offsets to this, because let's say that you get better at your manufacturing, and you get more efficient over time, and you say, well, I don't need as much manufacturing space, and I don't need as much raw material, but we're so fast at this, but there's still a lag between us moving product out the door. I need more space for finished goods. That space no longer qualifies. And the problem is, it's not only the fact that you have a recapture event. Essentially, you whatever portion you give back, you pick up an income, and then you pick up in basis. And then what also happens as part of this, when you elect QPP, you can't go back and say, well, it was QIP, I should get bonus depreciation, or it was a 5-year asset, I should get bonus depreciation. I think you can still reclassify it to a 5-year asset, but you've given up, at least the way it reads as an L, you've given up your ability to, take bonus or 179. And again, really, if it's, what this is meant for is non-residential real property. And then the IRS may fight you and say, well, wait a minute, if it is not non-residential real property, why did you take QIP on in the first place? So I don't know if you want to be, because now you are looking at earlier open years, but it is punitive in a sense that if you change your mind, it gets picked up in income, you pick up the basis, but then you start as at that point with your 39-year depreciation on that portion. So that's punitive. And if you're not sure that your space won't change, or, et cetera, then maybe hitting that easy button because you put up that building that is, 4 sides of roof and a concrete slab, and saying, well, it's all QPP, we're just going to deduct it. But then, if you're not sure what's going to happen 5 or 6 years down the road, it may be worth putting the extra effort to carve out the things that you could get anyway at, a 5-year life or something else. You're going to get a better state answer on those anyway off the bat, but then you're also going to protect yourself of how much of this you're actually, subject to this recapture provision in the future. And again, this is where I talk about, going back a little bit, I want to point out that, going from one, if you go from one production to another is not a change in use. And then if it's, you pull something out of process for maintenance, that's not going to trigger the recapture issue either. And then here, this is when just explaining on this slide, what happens. And then you've also, given up on bonus, et cetera, at least per this notice. Now, could there be some reprieve in the regulations? Sure. As far as those regulations go, I will say they are on the priority guidance list, but I'm not sure that, I'm not sure what that means. As we had to wait several years in TCJA for the 168, K2, the -2 regs, when they're essentially similar to -1, and it took 2.5 years for us to get final regs. So this one could take a while because there's certainly some things, and there's certainly going to be comments that they have to address. And just recapping before I take some of these questions, there were a few things I think in this notice that were left out. And again, I think, the breadth of what manufacturing, production, refining activity, what those are that results in substantial transformation. I think there's going to have to be some more work around that, because I think, QPP is going to be easier to figure out than, what the qualifying activity is. There were certainly, I think they gave us good ways to allocate between eligible and ineligible property, but there were some that they didn't necessarily say. They didn't tell us, well, what if you have things that overlap in the same property? So if easy example, if you have qualifying and non-qualifying, you have HVAC, power, you can use a reasonable method to bifurcate between the dual use. But what if you have, a non-qualifying event that happens, there's a lot of things, like, R&D activities that happen on the production floor. The notice doesn't address that. So I think that's one thing that's going to have to be talked about, in these regulations, or at least I would hope. And the other is for this integrated facility, that contiguous, space, what if you have natural boundaries and things of that nature, that those are not addressed? Is it still contiguous if you have a railroad track or a street going, or something else for that matter? I think there are going to be some questions around what that integrated facility is beyond what was provided in this notice. But more to come. Like I said, we still need, this notice is pretty good. It gave us, some very key important points. Just to recap a little bit. Yes, if you're a lessor leasing to your production activity, that will count for you, which, I think when the statute came out, had everyone a little bit, concerned about. You don't have to totally buy a new building or build a new space. You can add on to an existing space and still qualify for QPP. It does expand the definitions for us, to a certain extent. So that is helpful, but more to come. And I do have a couple of questions that I'll go through briefly, and then I think we are done. So someone did ask about, and this goes back to component election and when, or even the acquisition of when, for self-constructed property, about the 10%. So it is, and they said, is this, 10% of hard costs, not all costs. So it doesn't, it is, 10% of what people like to refer to as hard costs, but it's, the real rule is, you exclude land and preliminary costs. So if you think about preliminary costs, that is going to be your permitting, design fees, things like that. But you still, like with any, 263 big CAPA still makes you pick up a whole lot of things into your capitalization. But these, regulations for bonus depreciation let you exclude the prelim costs, which they do define out in those regulations. So it's not going to be everything that you might think of as a soft cost. So you're still going to have, management, et cetera. But you do get to take out land, permitting, and other preliminary costs. This is also the second question we have here that I'll answer is, what would be considered a component of a building? And the example or question is HVAC versus building envelope. So, and that's a good question. So to go back to that, the only thing for this component election, it has to be something that is bonus eligible. And the way these rules work is that the asset, when you're thinking about, the short life property that is identified within a building, the asset for bonus depreciation purposes or asset for this test is not the building itself. So the envelope is out because it was never eligible for bonus depreciation. If you had something acquired, then you had a project, where you were doing interior improvements, yes, QIP, and that would count too. That would be part of the. That would be, I think QIP would be its own because technically it's 1250 property. But you would take all the 1245 property as a whole, and that's your asset. And actually, to make this simple, if you knew that all you did was break ground and you did your foundation work on this building, and you said, all right, I'm over the 10% threshold on this building, but none of my 1245 property that we identified, that was done well after January. That was started well after, whether it be cabinetry, especially lighting, flooring, carpeting, things of that nature. All of that was acquired. 100% of the costs were incurred after the fact. Well, then via component election, it's easy for you. All your entire asset is eligible. What happens is, and this is where what's a component versus what's not, it does get hard, and it's very much, taxpayer by taxpayer. So if you think about the power, there's a certain amount of electrical wiring, and in a building, we would, segregate to 1245 property. Well, there are portions of that are, self-constructed. The total amount are just materials. They're not components. They're just materials. But you may also acquire, all your junction boxes or, certain other power components, that you are putting into this, building, generator facilities, et cetera, that you're acquiring, they're ready to be plugged in, plug and play. So you can have both. But I think the way that the easiest example is probably, for us would be, the way it's like finished cabinetry that we would take to a shorter life. That, and it could be both. Typically, in what we would see, you're not buying something that's already off the shelf at Lowe's. You're having someone construct it, but your contract matters. So that's why I said the component election can get very difficult when you're looking at a building. But essentially, when you're looking at the cost, everything, all that 1245 property, the starting point is identify that first, and then go to each of your components. So essentially, every subcontractor that works in that, what we've been segregated in your cost segregation study is 1245 property. And so you do have to get in the weeds, and that's why I think sometimes not taking the all or nothing approach and just taking the things that you clearly know, maybe it's contractor by contractor that got started later. So But if you have additional questions, the person that asked that, please reach out to us, and we're happy to get on the phone and just talk you through some examples. And I went a little bit over.
I think it's perfect. So we're all set. Thank you for joining us today. And we will be emailing out the presentation and recording in about 10 days or less than that. Thank you.